Hi students, it's a great day to be here again today. Thank you so much for tuning in. If you're new here, I'm Favor Olarewaju, aka God's Favor. Please do me a favor, that kind of favor. And I'm excited to continue to be your instructor for this class, Introduction to Microeconomics as in MICRO. As usual, we'll be using the textbook Principles of Microeconomics by Gregory Mankiw, the 9th or the 10th edition. And I'm all about breaking down complex economic topics into simple concepts and calculations that everyone can understand and relate to. Today, I'll be covering chapter 14, which is on the cost of production. So basically, we all know what production is, like manufacturing, but like what are the different costs that go into production for businesses and firms? And we'll be learning about that today. So there's an example here to start us off. So assuming we have an individual called John, and let's assume John is the CEO of his business, a food business, right? And then he produces about 95,000 burgers on a yearly basis. And assuming he sells each of the burgers for $5 each, if the cost of ingredients is $30,000, then you have equipment and machinery for $65,000 on a yearly basis, remember? And then the shop rent is $35,000, okay? And assuming you have wages for $120,000 for 4 workers, and he's paying them $30K each. So John could also work at a McDonald's restaurant for $25,000 yearly. So this is something else that John could be using his time for, aside from starting a business, okay? Assuming that he invests $65,000 into the business, out of the $65,000, he gets $15,000 from his personal savings, and then he takes $50,000 from the bank as a loan, and each of these savings and loan earns a 10% interest rate, right? Assuming. Okay, so now we have to calculate John's profits. The first thing I want you to note is that there is a difference between economic profit and accounting profit. So if anyone ever asks you what is profit, then you have to ask, is it the accounting profit or the economic profit? And I'm going to explain the difference shortly. So basically, accounting profit is the one that doesn't factor in implicit cost. So implicit costs are things that you cannot see, but things that actually cost the business. So for instance, the alternative use of time, right? So remember I said that instead of setting up this business, John could be working at McDonald's and be earning $25,000 on a yearly basis, right? So that is an implicit cost. So that is something else he could be using his time for, right? So accounting cost doesn't factor in implicit cost, and so it usually kind of inflates the profit. On the other hand, economic profit factors in implicit cost, and so at the end of the day, the economic profit is usually lower than the accounting profit. And we're going to get to that in a second. So basically, the first thing we need to do is calculate total cost. So total cost is equal to your implicit, we just talked about this, plus explicit cost. Now, according to this example, what is your implicit cost? You have $25,000, which is an alternative use to his time. What else could he be using his time for? So remember, when starting the business, he invested into the business, and this investment comes at an interest rate, right? So if he did not start the business, he would have still had his personal savings of $15,000 that could have been earning interest in the bank, okay? So now, 10% of $15,000, and then you also have 10% on the loan that he took out. So remember that when he has to pay back, like the cost of the business is not just the $50,000 loan that he took, it's also how much he has to pay back. He has to pay back that 10% on a yearly basis, okay? So those are his 3 implicit costs. And if we add that up, that is going to give us $5,000 plus $25K and plus $1,500. And that's going to give you $31,500. All right. Now let's go to the explicit cost, which is the one that everybody always remembers to look at. Okay, so your explicit cost for John, we talked about the cost of ingredients, $30,000. The cost of machinery on a yearly basis, $65,000. How about the cost for rent? $35,000. How about the wages he's paying his workers? $120,000. So if we add that up, that's going to give us $250,000. Okay, so this is his total of explicit costs. Now that we know the implicit and the explicit cost, that tells you that the total cost is a combination of this implicit plus this explicit cost. So $31,500 plus $250K, that is going to give you $281,500. Next thing, we're going to calculate total revenue. Total revenue is simply price times quantity. And we know that the price of each burger is $5, and the quantity sold on a yearly basis is $95,000. So by the time you multiply that, you're going to get $475,000 on a yearly basis, okay? So remember, all our calculation is on a yearly basis. Now let's move on to calculating the profits. So accounting profit is your total revenue minus your explicit costs, which is pretty much $475K minus $250K. And that gives you $225K profits. How about your economic profits? Your economic profit is total revenue minus your total costs. So remember, your implicit cost is also known as opportunity costs. So in other words, alternative uses of time, or what you are giving up to have this business going on. So total revenue minus your total costs, and that is simply 475k minus 281,500, and that is going to give you $193,500. So in that way, your economic profit is going to always be lower than your accounting profit, because your economic profit includes an additional cost, which is your implicit or your opportunity cost, that your accounting profit doesn't account for. So let's add a dynamic to it. So how about if the cost of rent goes up by $500 a month? So $500 a month would be $6,000 on a yearly basis. So then, should John decide to continue renting the shop, or should he just buy it out and own the shop? Let's calculate the different costs and what he should decide to do. So if he decides to rent, then that means his explicit cost is going to go up by $500 monthly, or $6,000 on a yearly basis. So it's going to cost him more on the explicit side. So therefore, if his explicit cost goes up, then that means the accounting profits is going to go down. So this is going to be 475k minus, now we're having an extra $6,000, so minus 256k, and that is going to lead to a new accounting profit of 219k. Now we see his accounting profit goes down as a result of the explicit cost going up. Now how about his economic profit? His economic profit is still going to go down because his total cost is still going to increase because of the $6,000 extra yearly rent. Okay, so his economic profit is still going to be 275k minus now 287,500, which is going to lead to a new economic profit of $187,500. Okay, so if he decides to rent, both his accounting profits and economic profits are going to go down. Okay, how about if he decides to own the shop outrightly? So his accounting profits, meaning that his explicit cost is not going to change, because now he won't be paying the extra $6,000 yearly for extra rent. So his accounting profit will remain the same, but the economic profit is going to change because implicit cost. So then the $6,000 would have been an implicit cost that he avoided, right? So the economic profit is still going to change to $187,500. So therefore, he should decide to own the shop rather than renting the shop. Okay, so now let's take another example. So remember that your total revenue is your price times your quantity, which is basically $5 times the 95,000 units of burgers sold, and that gives you $475,000 a year, right? Something that I want you to note is that in the short run, not all costs change. So the only costs that change or vary over time are your labor costs, so how much you pay for wages, because that's always going to change on a monthly basis, and your operational cost. You're always going to incur daily expenses on ingredients and everything that you need for the smooth day-to-day transaction of the business. However, things like the rents, right? So how much you pay for rent for your shop, that is a fixed cost. So whether or not you open business for the day or for the month, you're still going to pay the house rent because it's a fixed cost that you incur on a monthly and ultimately on a yearly basis. Fixed costs, also known as a sunk cost. So sunk cost is a cost that you cannot recover. So once you've incurred that cost, you cannot get a refund, right? Your rent is your rent. You're on a contract to pay that rent on a yearly basis. So it's best off that you actually open the business and make sales in order to be able to pay off that bill. Having said that, let's calculate different terminologies that has to do with production. So the first thing I want us to calculate is your outputs, which is not really like we're calculating it, because we already know the output level. We know that 95,000 units of burger is produced on a yearly basis. So this is just a hypothetical example. So I'm going to assume that initially 0 burgers was produced when the company was not in business. So remember, labor is one thing that varies over time. So at 0 workers was basically 0 production, right? So let's assume at 1 worker, then you have 25,000 burgers that was produced, and at 2 workers, you have 55,000 burgers produced. So what this tells you is that there is something called increasing returns to scale. So increasing returns to scale is basically when you increase inputs, then output increases by a greater proportion. So in this case, your labor is an input. So inputs includes things like labor, physical capital. So the equipment, the machinery, that doesn't change over time, because for instance, the computers or the griller, all of that, it's pretty much fixed. Whether or not to produce, like, it's there, like that cost is there. So that doesn't change over time. So only labor in this case changes over time, right? So when you increase labor from 0 to 1 worker, you can see that production went from 0 to 25,000 units of burger. And then when you now increase the labor from 1 worker to 2 workers, then you see that production more than doubled, right? So the outputs, your total production is your TP. So that more than doubles to $55,000, right? So that is known as increasing returns to scale. How about when labor becomes 3 units? Then the production of burger increases to 80,000. At this point, there's still an increase in production, but notice that this is now beginning to indicate decreasing returns to scale, or what is known as diminishing returns. So basically, initially you increase input, output is increasing by a greater proportion, but it gets to a point in time that the more you increase input, the amount of increase in the output reduces, it shrinks. So how about at 4 workers, you end up having 95,000 burgers that are produced, which is what we had in the example before. Now, the company still goes on, John still goes on to employ a 5th worker, And at that point, production only increases by 5,000 units. So you see that at this point, there's no point increasing workers again, because it's now becoming counterproductive, because when too many workers are in the same space, then the workers could distract themselves at work. The workplace could be congested so that one person is not able to work as freely as he was able to work before. So basically, too much of anything is not good, right? So at this point, the labor is becoming too much and production is now slowing down. So it's increasing at a much slower rate. How about marginal product? So marginal product refers to the inputs that leads to outputs. And it could be labor, it could be capital, but remember that since capital is fixed over time, at least in the short run, then what changes here is your labor. And MPL is your marginal product of labor. It means that for every worker that you add, how much does output increase by? And this is simply calculated as change in your total product divided by your change in labor. So when your labor increases from 0 to 1 worker, how much does output increase by? 25K. So at this point is 0. At this point, the change in total product is 25K. Divided by your change in labor, which is pretty much 1. So that's still 25K. How about when your worker increases from 1 worker to 2 worker? Your output changes by 55K minus 25K. That gives us 30K. Again, divided by the change in labor, which is 2 minus 1, which is still 1, so 30K. How about at 5 workers? You have output at 100K, so 100K minus 95K, that is going to be 5K. And then divided by the change in labor, 5 minus 4, which is 1. So 5K divided by 1 gives you 5K. All right, so that is how you calculate marginal product. Something I wanted to emphasize is you can also calculate average product, but average product will simply be total product divided by labor. So remember, product has to do with your input, so either labor or capital, not quantity. Okay, so at 1 worker, you would have your average product 25K divided by 1, 25K. At the second point, you will have 55K divided by 2, which is going to give you 27,500. How about at the third point, you're going to have 80K divided by 3, and that's going to give you 26,667 units of burger on average. So average product is just simply saying, what is your output on average per worker? How about fixed cost? So we know that the shop rent is 35K and that he also bought equipment and machineries for 65K. So the addition of that is going to give you your fixed cost. At least in the short run, that doesn't change. So your fixed cost is going to be 100K, right? So irrespective of the number of workers, he has that fixed cost, okay? So fixed cost is going to be the same. I'm just going to say 100K, so you understand what I mean, $100,000. Notice how total product and marginal product do not have dollar because it's referring to the quantity amount that is produced per labor. All right. Now, how about variable cost? We know that the labor is 120K for 4 workers, meaning that he's paying 30K per worker. And the ingredients is about 30K on a yearly basis. So now let's break it down. Let's assume that at 0 production, it was 0 cost. And then at the point where you have 1 worker and you have 25,000 burgers produced, let's assume that the cost of ingredients was just 10K. And then the cost of labor is fixed at 30K. So this gives you a total of 40K. And at 2 workers and 55,000 burgers produced, you have 20K for the cost of ingredients, and then you have 60K for the wages paid. So that gives you a total of 80K. Let's assume at 3 workers where you have 80,000 burgers produced, you have 26K for the cost of ingredients plus 90K for the cost of wages to workers. So that's going to give you 116K as your variable costs. Let's assume now at 4 workers you have 30K for the cost of ingredients, which is what we looked at in the previous example, and 120K for wages. So that's going to give you a total of 150K. Now how about total cost? Total cost is just the sum of your fixed cost and variable cost. Your fixed cost and your variable cost only account for your explicit cost, okay? And the total of that is going to give you your total cost, assuming we don't want to look at implicit cost for now. So at 0 production, you have total cost of 0. At 1 labor, at 25,000 burgers produced, you have 140K as your total cost. So 100K plus 40K. At 2 workers and 55,000 burgers produced, you have 100K as your fixed cost plus 80K. So that's going to give you 180K. And at 5 workers, 37K for the cost of ingredients plus 150K for workers. So that is going to give you 187K. And then your total cost is going to be 100 plus 187K. So that's going to give you 287K. And now your average fixed cost is going to be your fixed cost divided by your quantity. So average fixed cost is like on average, how much is your fixed cost per worker? At 0 production, you have 0 average fixed cost. At 25,000 burgers that are produced, you have a fixed cost of 100K. So 100K divided by 25,000. That is going to give you an average of $4. So basically on average, $4 is spent on fixed cost per burger produced. At 2 workers, same concept, 100K divided by 55K burgers, okay? So not dollars, all right. And that's going to give you $1.8 on average. How about at 5 workers? So that's going to be 100K fixed cost divided by 100,000 burgers produced. So that's going to be 1. So notice how on average your fixed cost reduces over time because you're able to increase the quantity that is produced. How about average variable cost? How much is your variable cost on average per output? Variable cost divided by quantity. At 0 production is going to be $0. At 25,000 burgers, your variable cost here is 40K divided by 25,000 burgers. Anything here 80k divided by 55,000 burgers. That's going to give you something. And then the next one is going to be 187k variable costs divided by 100,000. So do the calculation of this. You're going to see that it's going to maintain the same pattern where the average variable cost is going to reduce over time. Okay. How about average total cost? So your total cost at zero production is zero. At one worker or 25,000 burgers produced, you have total cost $140,000 divided by 25,000 burgers that are being produced, and that is going to give you $5.6. The same concept for the second one. Total cost at 55,000 burgers produced is 180k. So 180k divided by 55,000, and that's going to give you $3.3. And at the fifth level, you have 287k dollars divided by 100,000 produced, and that's going to give you 2.87. How about marginal cost? Marginal cost is the difference in total cost that results from increasing outputs. At zero production, you have $0. Between 25,000 burgers produced, 140k minus $0, that's going to give you 140k as a marginal cost. How about at the next level, you're going to have 180k minus 140k, so that's going to give you 40k extra cost. And then 287,000 minus 250,000, that's going to give you a difference of $37,000. So that is basically how you calculate different kinds of costs. Now notice how initially cost is reducing the more you produce. That is what we know as economies of scale. So when you're able to increase production, you're able to get things in bulk and then save cost ultimately, right? But then when you're overproducing, right, so you're producing way much more than is required, employing too many workers and all of that, it becomes inefficient, and then eventually the cost starts to increase back up. Okay, something that you should always remember is that your average total cost is basically the same thing as your average fixed cost plus your average variable cost. Okay, so in this case, since we didn't do the math here, we know that $5.6 minus $4 should give you your average variable cost. So that should be $1.6. In the same way, $3.3 minus 1.8 should give you the difference here of $1.5. So you can fill in the gap for the rest of the levels. In the same way, your total cost is the summation of your fixed cost and your variable cost. So if you're looking for your variable cost, for instance, you just need to do total cost minus fixed cost, and that will give you your variable cost. So in other words, 140k minus 100k is going to give you 40k, right? So assuming you're given a table with blank spaces, that's how you fill it out. Also, your average variable cost is your variable cost divided by quantity. So your variable cost will simply be your average variable cost times your quantity. So this average variable cost times quantity, your output, is going to give you your variable cost. And the same thing applies for average fixed cost. So average fixed cost times quantity is going to give you your fixed cost. Okay, so that's how you manipulate the formulas to fill in the blanks. Okay, so let's move on to the graph. So how did the graph look like? At one labor or 25,000 units of burger produced, your average fixed cost is $4, and at the next level, at 55,000 burgers produced, your average fixed cost is 1.8. So it drops somewhere here. You drag it down to where the 55k is, and you mark it with an asterisk. At the third point, you have $1.25, which is like $1.3. So here, you drag it down up to the point of 80k. At the fourth level of $95,000, you have 1.05. So that's pretty much slightly lower at 95k. At 100k, you have $1 on the dot. You can drag it down all the way to where 100k is. So basically, your average fixed cost is going to look something like this. How about your average variable cost? It starts off at $1.6 for 25k. So $1.6 will be somewhere here. The next point will be $1.5, slightly lower. But if we continue with that trend, your average variable cost is going to look something like this. Okay, so average variable cost. How about your average total cost? That starts from $5.6, so all the way up here. At the next point, you have $3.3. Drag it all the way. So this is going to be your second point. Your third point is going to be $2.7. Drag it all the way to where 80,000 burgers end. You mark it. Your fourth point is going to be $2.6, so slightly lower. And then your next point is going to be $2.87. So you see it starts increasing back up. So it's going to be slightly higher, 100,000 burgers. Okay. So your average total cost is going to look something like this. Average total cost. So you see that your average variable cost and your average fixed cost are way below, and your average total cost is on top, right? Of course, that's the highest of the average costs. All right. How about plotting your fixed cost, your variable cost, your total cost, and your marginal cost? So again, fixed cost, you notice that it's pretty much constant at 100k. So that's just going to be a straight line right here for your fixed costs. How about your variable cost? So at this first point is going to be 40k. At the next point is going to be 80k. At the next point is going to be 116,000, so slightly below 120. At the next point is going to be 150k, so somewhere here. and at the last point for 100k is going to be at 187,000. So you see that your variable cost is pretty much like this. How about your total cost? Your total cost starts from 140k, somewhere here at 25,000 burgers produced. The next point is somewhere here for 55,000 burgers produced. Next point 116k above. Then you have as high as 250k and 287k. So that's going to be way above. Okay. So you see that this is how your total cost looks like. So how about marginal cost? Marginal cost starts from 140k, is somewhere here, and the next point is 40k. So it drops, and it goes on dropping to 36k, and still drops to 34k, and then it starts slowly rising back up to 37k. So basically, your marginal cost looks like this. So you see how your marginal cost drops and slowly increases if cost becomes too high. All right. So something I want to really emphasize is that your marginal cost is basically going to intersect your average variable cost and your average total cost at its lowest point. So basically, when your marginal cost is less than your average total cost, then that means your average total cost is reducing. But when your marginal cost is above your average total cost, then that means your average total cost is increasing. So to quickly show how your total product curve looks like, it first starts off by sloping upwards, then it reaches its maximum, it flattens out, and then slowly starts to decrease if care is not taken. So basically at 25,000 burgers produced, you have equivalent of having one worker, and at 55,000 burgers produced, you have equivalent of having two workers. At 80,000 burgers produced, you have three workers. At 95,000 burgers produced, you have four workers, and at 100,000 burgers produced, you have the max of about 5 workers. Afterwards, production is most likely going to start reducing because the workers are becoming inefficient because they're way too much at this point. Okay, so again, diminishing returns to scale or diminishing marginal returns. The last thing I want to illustrate is that in the long run, all inputs vary. So now, including things like fixed costs, those things actually start to vary because in the long run, you have companies now deciding to expand their production, set up multiple companies, or to shut down, close down business, whatever the case is. But in the long run, all the inputs are going to vary, including your land, rent, all of that. That's going to vary. So basically, the long run is a combination of all the short run costs. So imagine a company that decides to expand and have multiple branches. That kind of firm would have different short run curves, where each short run curve represents the cost of production for each firm. So basically, it would look something like this. These are 3 different curves for the short run. So let's say short run curve 1, short run curve 2, and short run curve 3, right? So in the long run, if you have to aggregate this, it's going to simply be one big curve that looks like this. So this bottom one curve would be your long run curve that combines all the short run curves. Okay, and that's that for chapter 14. I know it's been a lot of calculations and graphs, but I hope I've been able to break it down in a way that makes sense to you better. Thank you so much. Don't forget to like, to share, to subscribe, and to tell your friends all about this channel. See you in the next chapter.